Hello, everyone. Welcome to this webinar on Tax and Accounting 101 for Technology Startups. I'm your moderator, Jenny Alton, from the New York Small Business Development Center Central Office. This webinar is brought to you by the PACE SBDC, a regional center of the NYSBDC. The NYSBDC is a U.S. Small Business Administration resource partner with regional centers at higher education institutions and outreach offices at other locations across New York State. Our free advising, education, research, and advocacy services are made possible by funding from the SBA, New York State, and our host campuses. Greg from the PACE SBDC will address us in just a few minutes here. We have as our main presenter today, Akshay Shrimanker, CEO and founder of Shay CPA. So you know, we are recording today. We will share links to a PDF copy of the slides and recording in a follow-up email. Attendees are muted and will not be on camera today. We'll be running some polls and asking for you to respond to some questions in the chat today, so make sure that you are ready to do that. If you have any questions during the presentation, please don't hesitate to type them in the Q&A box as they come up. You can open Zoom's Q&A box from the Q&A button at the bottom of your Zoom window, and we're going to try and address some questions as we go along throughout the presentation. With that, I will turn the time over to Greg Callender, Certified Advisor with the PACE SBDC.
Thanks, Jenny, and hello, everyone. I'm Greg Callender, a business advisor with the Pace University Small Business Development Center. The Pace SBDC provides a wide variety of services, all free of charge, to both existing New York small businesses as well as to aspiring entrepreneurs who are looking to start a business. An example of some of the services we provide include helping entrepreneurs to obtain financing, assisting with comprehensive business plans and financial projections, developing social media and marketing strategies, applying for MWBE certification, and gathering market research. The PACE SBDC's one-on-one services are offered both in person and via Zoom. They are also offered both in English as well as in Spanish. In a few moments, I'm going to place into the chat two links. One is going to be to the main PACE SBDC website, where you can learn more about our program. And the second link is one that will allow you to register for free PACE SBDC business assistance. In addition to the free one-on-one advisory services, we also offer a variety of training and educational programming. Today's event is part of those efforts. We've been very fortunate to have members of the New York Society of CPAs volunteer to share their professional expertise with business owners on a variety of small business accounting and tax matters. As technology is playing an ever-increasing role in our lives, we at the PACE SBDC are seeing an increasing number of technology-related clients. Since many industries have financial record-keeping nuances that are unique to that particular sector, we are extremely lucky to have Mr. Akshay Shrimanker, a CPA whose firm has a focus on the technology industry, present to us today. Thank you very much, Akshay, and the floor is now yours.
Thank you, Greg, and thank you, Jenny, for having me today, and hello to the PACE SBDC community. It's great to present to you today some basic information regarding tax and accounting for technology startups. Just a quick disclaimer, the information I'm sharing is really for informational purposes only and should not be construed as financial, tax, or legal advice. So for your own specific circumstances, please consult with a professional tailored to your specific situation. So with that said, I'm going to go ahead and kick off. So a little bit information about myself. I'm a CPA out of New York. I've been working with technology companies now for over a decade, helping them with bookkeeping, tax compliance, R&D credits, and our firm also offers fractional CFO services. We're a small team, and a big part of our ethos is working with college graduates from the CUNY ecosystem. I myself graduated from Baruch College in the city, and we've been lucky to be able to work with some great companies that have come out of prestigious incubators such as Y Combinator, Techstars, and 500 Startups. And it's also great to partner with organizations like the PACE SBDC across New York City, hosting presentations, workshops, and office hours. So today I'm going to go over some practical tips for you. So we have some QuickBooks tips. We'll talk about some upcoming deadlines. There's some new filing requirements as part of the Corporate Transparency Act that I believe you all need to be aware of. And then we'll talk about, if this is your first year in business, we'll talk about the corporate tax for initial year considerations and startup expenses. We'll also touch on state income tax and franchise taxes. And finally, we'll touch on R&D tax credits and some R&D capitalization requirements, which will also impact how your taxes are prepared. I'm gonna have Jenny send out the first polling question now, just so I can learn a little bit more about the attendees that are here today. So I'll just have Jenny share that in the chat. And yeah, and with that, I will kick off. So I want to make this pretty interactive. So yeah, here's the first question. Are you a tech company? And we're going to talk about QuickBooks tips first for tax time. So right now it's October 31st. You have 2 months until year end. And as a business owner, you are busy. You have other priorities, especially if you're running a tech company. And there's only so much time in a day that you really have to oversee your accounting and your finances. So I want to highlight 3 areas that I think that you can make the most use of your time. And or if you have hired an accountant or are working with a CPA, some things that you can check that they are doing correctly or they're actually monitoring. And this should help you understand whether your books are being kept in order or not. So the first thing that I want to talk about are bank and credit card reconciliations. So bank reconciliations are a great internal control, and they are essentially a way that you are matching your books and records, what's actually in your accounting system, with third-party documents. So your bank account, you can download your bank statement, or that may be mailed to you. That bank statement has the actual it has the actual balance on it, and that you need to be comparing to what's actually recorded in your books. So simply syncing and adding transactions that are coming out of your accounting system isn't always accurate. Sometimes there are bank sync issues, meaning not all the transactions are being synced correctly. Other times you don't have all of your bank or credit cards connected to your accounting system. And this is a great internal control to make sure that your books are including everything that is going through your financials. So let me just stop sharing for a moment. I'm going to go into QuickBooks. And for those of you who are using QuickBooks, just quickly show you where that information can be found. So typically, this is a sample company in QuickBooks that I've opened up. So if you click on this gear icon here in the top right corner, there is an area called Reconcile. If you click into Reconcile, you can match the books to the bank records as it shows here, and it has some good info on how to do that. If you click Get Started and Let's Get Reconciled, this is the area where essentially you can begin to reconcile your account. So statement ending balance, essentially what is being looked for there is what was that actual bank balance in the company's bank account. So in this case, we're looking at the checking account. So let's just say it was like $12,000, and we are reconciling the end of this month, and then we click Start Reconciling. So this is the steps that your bookkeeper or your accountant needs to be going through on a monthly basis to ensure your financials are actually matching. And without going through this step, essentially what's happening is your books may be out of sync. So here you can see there's a $7,000 difference. Once you actually go through and match your actual records to see what was actually matching, that's when you can zero in on what is making up that difference. And yeah, so this is just a demonstration, but it's a good way for you to just see, hey, what's in the actual accounting system? Is it matching what's actually going through my bank account? So this is the first step as a business owner as to what you should be looking at, or you should be monitoring that your accountant is doing. The second thing as a business owner that you can look at is the accounts receivable analysis. Now, why is this important? So understanding your accounts receivable can help you prevent underreporting or overreporting on your taxes. So accounts receivable is essentially a schedule that shows the customers that you have and the balances that those customers owe you. So from the time you send the invoice to the time they pay you, if those invoices are outstanding, then essentially, these are customers that owe you money. So you may have bad debts that need to be written off. And on the accrual basis of accounting, this can actually help reduce your tax liability. For some tech companies, if you are a B2C business, you may be doing your billing directly through Stripe or another billing module like ChargeBee. So you may not have to deal with accounts receivable as much. But if you are in the B2B side, typically even tech companies will have to deal with some level of accounts receivable. And based on the survey, it looks like roughly more than half of you are non-tech companies. So this is definitely a report that you want to be analyzing. So I have an example here of what an accounts receivable aging report looks like. This is a report you can pull from your accounting system or from QuickBooks, which shows, here it shows the customer name, the total balance due, and how many days out is it still outstanding, right? So what you want to be looking at here as a business owner is, hey, do we have customers who owe us balances that are over 90 days? Because these are the customers that are going to be, that you may need to now contact or understand why is it that they are not paying you? Is it something in the services that you're offering that that they are not happy with? Or is it simply those customers are having cash flow issues? And the main reason this is an issue for a lot of tech companies is that if you have, you have a certain number of runway, a certain runway or a certain burn rate on a monthly basis, not having your accounts receivable balances being paid regularly is going to impact you being able to pay your vendors and your employees. So this is a critical report that you should have your bookkeeper or accountant run for you on a monthly basis. If you're maintaining it on your own, it's something that you should periodically check, at least quarterly at the bare minimum, so that you can confirm balances. One of the things I find really interesting when I review this report with our clients is sometimes they'll say, hey, that client is, we need to write that balance off, or this other client actually we're having a dispute with, or this other client that, they said that they're going to settle these balances over the next 3 months. And I believe it gives great clarity to business owners to understand when their customers are going to pay them. So let me stop sharing for a moment and I'll go into QuickBooks and I'll show you where you can run this report in the system. So in QuickBooks, under reports, you could see this report called Accounts Receivable Aging Summary. So here you could see for Craig's Design and Landscaping Services, all the different customers that this entity has, and then the balances and how far out they are. Now, if you're a traditional tech company and you're using another system like Stripe or ChargeBee or another billing module, you can generally run reports like this, but within those systems. But if you're doing all your invoicing out of QuickBooks, you can run these reports out of QuickBooks. In some cases, you can connect Stripe or other third-party billing engines to QuickBooks because they have a fairly large integration suite, and you can sync all your invoices here. So you can have one unified place to see who owes you money. So this is my second tip. Make sure you review your accounts receivable. And sometimes we've also seen salespeople who may be involved in your company or send an invoice, but the actual invoice was supposed to be an estimate. And now you may end up paying taxes on income that which is never supposed to be received or wasn't approved. So that's another common issue that we've sometimes seen, is that a PO or estimate is turned into an invoice by mistake, and that can create a tax issue because you may end up then showing that as income when it wasn't, and now ending up owing income tax or potentially sales tax as well. So
Akshay,
oh, yep, go
could
ahead,
I ask
Jenny.
you a question that one of our
Sure.
attendees has? This person said FTX was criticized for using QuickBooks. Is QuickBooks inherently inappropriate for larger companies? What's your opinion on that?
Yeah, that's a great question. So I think QuickBooks is a great platform to use for small businesses. And as your business begins to scale, so for tech companies, that scaling typically happens in the different fundraising rounds that the company has. So whether that's seed, Series A, Series B, Series C, etc. At that point, as your business scales and your fundraising scales, you may be able to raise more funding, and you may be able to build out your own internal finance team. So whether that's hiring a VP of finance or a CFO, typically, if you're going to be graduating from a system like QuickBooks or Xero, it usually happens when you have an internal finance team, right? So you'll have like an accounting manager. You may have someone that does your accounts payable, someone who does your accounts receivable. When you get to that point, that may be a point where you think about moving from QuickBooks. QuickBooks does have an enterprise edition that they recently launched, but there could be other ERP systems. So most tech companies, they usually use, I'm not promoting any specific solutions, but just to name a few, they use tools like NetSuite, which is a fairly large tool, and the cost of it is to match. It's an expensive tool to use, but to use a tool like that, you also have to have that internal team. If you're still working with an outsourced accounting firm or a CPA who just helps you on a monthly basis, using a system like that may be overkill. So I hope that helps answer the question.
Yes, thank you.
So going back to the presentation, we talked about accounts receivable. Okay, so then on the flip side, what you have is accounts payable. So now, you're done looking at the customers who owe you money. Now, who do you owe, right? So, and this is another report where you can help spot missing tax deductions. And I frequently see founders receiving bills, especially from their attorneys, maybe their accountant, that they don't want to record in their books. So maybe it's like something that's in their inbox that they haven't recorded in their accounting system. But that could be, if you're on the accrual basis of accounting, a tax deduction. So the accounts payable aging report is going to help you spot those. Also, you may have vendor balances that you have already paid. So we've seen some examples where your accounts payable team has either duplicated a bill or recorded the wrong amount. And that also creates issues because now you may overpay a vendor because you have two bills in the system, or underpay, right? So you want to review this report fairly periodically, just so that you are on top of the folks that you owe money to. And then I think for small businesses, I generally describe this report, I almost see it like a credit report, right? And the reason for that is, and I'll go on to my next slide, is that if you have vendors where you owe them money and they're all over 90 days, What that's going to tell you is that next time you go and try to procure services from them, and you didn't pay their invoice, and you're also like an early stage company or a startup, they are not going to want to extend credit terms to you, right? They're going to say, hey, pay us upfront. And by the way, you have this balance, pay all of that too before we work with you. If you're managing your money well and paying your vendors on time, I'm not saying you have to pay them immediately, but you kind of come up with a good solution where hey, we get at least 30 days to pay our vendors, and try to keep things under 90 days wherever possible. That is going to speak volumes for you, because going forward, when you do get into a tricky spot financially, some of your vendors will be more likely to want to work with you rather than those who like you just take months and months to pay, right? So it also shows good habits that that you as a business owner are disciplined with the way you spend cash. You're only spending cash that you have and not spending cash that you don't have. So just to summarize, and let me go into QuickBooks, and I'll just quickly show where this report can be found. So in QuickBooks, again, it's under the Reports tab, and then you can go into, so there's this Who Owes You, and then Who You Owe, and there's an Accounts Payable Aging Summary, which you can run. And here you could see the different vendors you owe and how much you owe and how many days outstanding those bills are. So to summarize, 3 things as a business owner you can do before the end of this year to make sure that your books are in order. Review your bank and credit card reconciliations, review your accounts receivable, and review your AP, accounts payable, aging. If you do these 3 things, your books will be, I would say, 85 to 90% right, because there could be some other adjustments. Maybe like you have postage that you recorded as supplies, but it actually should go in the postage category. There could be like reclassifications, the way you've categorized and bucketed things. But if you do these 3 things, reviewing these reports and making sure your bank and credit card reconciliations are done, or your bookkeeper is staying on top of them, then that will ensure that your financials are clean. So that would be my advice for all of you. And this applies to tech companies and non-tech companies alike. I guess at this point, we can maybe send the second polling question, which is, are you currently in business? And for those of you who are in business, I want to just alert you to some upcoming tax deadlines that we have coming up. So, and reporting deadlines. So January 1st, this is actually brand new, and I'm going to touch on this a little bit later, but there is a new reporting requirement for beneficial ownership information reporting. I'm not sure if the SBDC is doing a separate workshop or presentation on this, but there is a lot of information out there regarding this report. So I would recommend any entities that are LLCs or S Corps or C Corps to look into this for your own company. January 31st, if you have employees or if you've paid out contractors, this is when your 1099s and W-2s are due. March 1st is when your Delaware annual franchise tax. So for most tech companies we work with, they're typically registered as Delaware C Corps. So their tax returns are due on March 1st. So it looks like about two-thirds of you, roughly, a little over 2/3 of you are in business. Okay. So on March 15th, partnerships and S Corp tax deadline for the extension. And then April 15th is if you are incorporated as a C corporation or your personal tax returns. If you're a single member LLC or a sole proprietor, that's when your taxes are due. There are also some estimated tax deadlines that fall in the middle of January. I haven't put that on this list, but that may also apply to you if you owe estimated taxes. And then there could be some potential sales tax deadlines as well if you owe sales tax, but those differ depending on the state. So additional considerations. So for a lot of tech companies, besides just paying out contractors, they may have also issued debt instruments like convertible notes, and they may need to issue 1099 interest statements. They may have other payments like royalties, and these are reported on different types of 1099 forms. So what I typically see with tech companies is that in the beginning, it may be fairly simple, but because of the nature of how tech companies work, there are some unique tax reporting mechanisms based upon the types of payments that you have. With tech companies as well, they typically issue stock options to their employees. So there could be incentive stock options or non-qualified stock options, and there's like a whole range of reporting for that as well. So I just want to highlight that those are also due next year.
Okay, actually, we have a couple of questions in the chat. So first is from Lydia. She asked, how do I determine the cost percentage of my home internet service and utility bill should be an expense to my e-commerce business?
Okay, great question. Yeah, so I guess that's to do with the home office tax deduction. So typically, the IRS uses the square footage of your home or your apartment as a starting point, and then the area that is exclusively used for business is the portion of the home that you can use as a tax deduction. So just to give an example, if you have an apartment that's, let's say, 1,000 square feet, and you're using about 100 square feet of that apartment for your home office, then you essentially could deduct 10% of some of your utility, your rent, some of your costs, and that would be reported on your personal tax return if you're filing as a single member LLC. If you're incorporated as an entity like a C Corp or S Corp, or if there's a partnership, it's a little bit more complicated. So I would definitely recommend you reach out to your accountant about that just to get the specifics on your specific situation. But that's the general idea. The IRS uses square footage.
Hey, thank you. And then we have a second question from Beverly asking, please discuss Quicken and whether it's a good software program to use.
So my understanding of Quicken is that it was like one of the first personal finance softwares that it was really targeted towards individuals. And I believe QuickBooks is like I think Quicken was launched or is connected to Intuit. But at this point, Quicken is more of a personal finance tool rather than a tool for business. But I'm not too familiar with the software, so I'm not sure if they are now offering some types of services to businesses. So I really can't speak to it too much.
Okay, thank you. That was the last question we have so far.
Great. So it seems like quite a few of you are in business, and for those of you who this may be your first year in business, I just have a few tips for you. So to any sort of tech founders that are planning to raise capital from venture capital or angel investors, some key things that you may need to think through. One is called an 83B election. If you are a founder in a C Corp and you are issuing restricted stock in your company, then typically an 83B election needs to be filed within 30 days of you purchasing stock in your company, and failure to do so could lead to some rather draconian tax consequences if not completed correctly. So if you are in that boat of having a tech company and it's your first year, I've seen a lot of founders sort of screw this up, and it has real consequences and it can create a lot of issues. So please speak to your accountants, your attorneys to sort of make sure that this is something that when you are initially creating your company that you take care of fairly quickly. Second thing is reviewing your SS4 and agreeing to your articles or restated articles of incorporation. So the SS4 is the form that you file with the IRS to receive a tax ID number. So your tax ID number is linked to your company name. One of the things that we frequently see early on with companies is that they either pivot or they change their name. So they begin as one thing, but then they change their name within a very short period of time. And if you don't let the IRS know that, or if you don't let your accountant know that, hey, I've gone through a name change, when the tax accountant tries to file the tax return, it may not go through just because the name is different. So that's something that I would review really quickly with your accountants for this filing season. The other thing is the first year is typically going to be a short year tax return, especially if you didn't begin on 1/1/2024. So your tax year really begins from somewhere in the year to the end of the year. So that's just one thing to consider when you need to be doing your bookkeeping from. So let's say you began in June of 2024, then your bookkeeping really would be from the period June to December. And anything before that would be considered the next bullet here, which is startup expenses, which have its own rules, which I'll go over in a moment. Other considerations, accrual versus cash. So a lot of tech companies, they more often than not, they are on the accrual basis for tax and book purposes. Let me just explain the difference. So an accrual-based taxpayer means someone that records their revenue when it's earned and records their expenses when they are actually incurred. So what that means is when you send an invoice to your customer, you would record that invoice as revenue under the accrual basis, versus on the cash basis, you would only record that as revenue when the cash is actually received. And the same thing with expenses. So under the accrual basis, you would record your bills when you receive them, so not necessarily when you pay them. And under the cash basis, you would only record bills when you actually pay them. So when you file your initial year tax return, you have to make an election which one you're going to be. And sometimes I see this also being a bit of a foot fault for founders. They pick the wrong one, and then you have to file some paperwork to change it later on. So this is something I would just discuss with your accountant. Next thing, I mean, we talked about those three major steps when you're doing your bookkeeping. Are your bank recs done? Credit card recs? Is your accounts receivable and your accounts payable balances up to date? Because that will tell you, for the most part, that your financials should be in fairly decent shape. Next thing is stock ownership. So with tech companies, they typically issue shares in their company or other debt instruments like safe notes or convertible notes. And a lot of that is indicated on something called a cap table or a capitalization table. This could be a third-party tool you're using like Carta, or it could be a Excel spreadsheet or a Google Sheet. This is something as well critical to keep up to date. And then another question here, another thing that comes up quite often is foreign founders. So if you are a foreign founder, meaning you're here in the US, or you could be abroad, but you're not a US citizen or green card holder, you may be on a student visa and considered a non-resident of the United States, there are certain tax rules that apply to you. And if you don't follow them, there are really draconian penalties. Like there are some penalties that range from $10,000 to $25,000 for simply not filing a piece of paper to disclose certain information. So I want to point that out. And then finally, there's this QSBS, and I'll talk about that on the next slide, which is qualifying small business stock. This is a fantastic tax benefit for any C corporation founders who are doing business in the United States. There are some fairly strict requirements to qualify for this, but the long and short of it is if you qualify, you can get up to 100% exclusion of capital gains taxes up to $10 million or 10 times the aggregate tax basis of the stock that you own in the company. certain industries are excluded. So for instance, law firms, accounting firms, insurance, farming, these are excluded. But if there is some type of tech element to what you're doing, you potentially could qualify for this. You also need to hold on to your stock for 5 years. And this is only for individuals that can benefit. Individuals and or in some cases trusts can benefit from this mechanism. So something that you should be aware of if you are registered as a C corporation in the tech business. Are there any other questions that have come up, Jenny, or before I continue?
The first one is,
Sorry, you're just your sound is not coming through.
Thank you. So yes, the first question is, what other accounting softwares do you see as good options for small business owners? I know we're looking particularly in QuickBooks today, but what other ones are good options as well?
Yeah, so for small businesses, there's a few others like Xero, Xero. There's another one which operates on like a premium model called Wave Accounting or Wave Apps. And then there's another called FreshBooks. And then if you want to go up to like the ERP outside of NetSuite, there's quite a few new startups in the space that are about at the moment. So that I think what I've been seeing, there's a proliferation of systems that are starting to compete now with QuickBooks. So there's kind of no shortage. But feel free to, if you want to, you could take down my contact details and I can kind of share a comprehensive list if anyone wants one, or if anyone wants to pick my brain about any particular system they may be evaluating.
Thank you. The next question, and Greg, I'd love to have you chime in on this one as well. This person is wondering how to locate a good and affordable accountant, what to look for. So Akshay, if you want to start, and then we'll have Greg talk about that as well from his perspective.
Sorry, Jenny, I just missed the first part of that question.
No
So
problem.
yeah.
How to locate a good and affordable accountant, what to look for.
Yeah, so this series of presentations is being held by the New York State Society of CPAs. So outside of myself, I'm a member of the New York State Society of CPAs for over a decade now, and there are quite a few other members. So I would definitely look at that network to see or be recommended to an accountant that may be a good fit for your industry or what you're doing. And I think like nowadays it's really about like seeing reviews, Google reviews, Yelp reviews, using those online resources. I think nothing really beats word of mouth, like getting a good referral from people that you trust and know that have worked with folks. So I think that's that's the golden one that I would follow.
Yeah,
I'll let
I guess
Greg
I would just
chime in.
Yeah, I would echo Akshay's comments. Like any sort of service provider, attorney, or any sort of service provider. Yeah, I think referrals. If you know anyone that can refer someone to you, that's always a good place to start. Ideally, you'd be able to identify an accountant that has worked with similar companies from an industry perspective. One of the reasons why we have Akshay presenting to us today. And what I can also do, if you like, what I'll put into the chat is a link to some previous webinar presentations that have been made by Akshay and some of his colleagues at the New York Society of CPAs. So anyone who's interested can take a look at the videos and reach out to any of the accountants that they choose to and speak to them about arranging for service possibly.
Thank you so much, Akshay and Greg. We do have another person on the webinar today who you spoke about that name change. And so they've sent in a notification to the IRS with it on the certificate of amendment from New York State. How long does this person need to wait if they are filing quarterly taxes? So like which name should they file with for their quarterly taxes, Akshay?
Okay, yeah. So with the name changes, it could be a little tricky. So if you have an accountant, you can have, or if you have an account with, especially if you're a New York business, you can change your address through the following link, and maybe Nina can add this to the chat. It's tax.ny.gov. If you click into that link, you can sign into your essentially there's a portal for your business, and there's a way to change your address from a state level in that system. So that can be done completely online. For the IRS, they have began to create some modernization in the way you can communicate with them. But at the moment, as per my last recollection, you have to actually fill out a form and mail that form in. And anything that's with snail mail, it's going to probably take 30 to 60 days, like on average, where it's going to take for you to get a notification back. But thankfully for New York State, you can actually change that address through the tax.ny.gov website. You just got to create an account in there, link it to your business, and then there you should be able to update it.
Thank you. We do have a couple more questions, but I want to be mindful of time with the rest of your presentation. Would you like to hold these questions for now, or what would you like to do, Akshay?
Sure. So yeah, I can, if there are more questions, I guess I can field them. I want to make sure everyone gets the most out of this presentation. So
Sure.
yeah.
Thank you. So we have someone who is currently a solo founder, but looking to grow. And so which legal entity do you recommend for a fintech or edtech startup?
Yeah, so I think from a tax standpoint, there's a couple of options. You can either continue as a sole proprietor if you're a solo founder, and then once you get a little bit more traction, or if you have some product market fit, or you have your MVP. I know these are other workshops that the SBDC has also run on, like just getting your business off the ground. Once you kind of have that, and maybe you've run a pilot or tested this with a few customers, at that point, that decision as to like whether you want to be a LLC or a C Corp is going to come up. And I think the decision to be a C corporation is really centered around, are you going to be raising investment from angel investors or venture capitalists, or are you going to be privately funding the business? If you're going to be privately funding the business, you may be able to create a LLC, like a Delaware LLC or a New York LLC for a few years until you're ready to take that next step where you really want to scale your company. The tech companies we're working with, they typically are more on the scale side. They are going to be raising capital from VCs or angels, and it's all about high growth. If you are, and there's nothing wrong with either way. Sometimes I think like with what's popularized on TV and like shows like Silicon Valley and everything, and what you see on the internet is that it should be all about high growth. But for your journey, it may be completely different, right? It may be, hey, I need to set up a LLC first, and let me take baby steps. So these are great questions that you should also speak to your legal representation with as well, just to ensure that the type of work that you're doing, especially in the fintech space, it's highly regulated for the most part. So if you're dealing with banks or people's personal financial data, there's a whole other regime of rules that you have to follow. So that's another thing that you need to check on before you kind of decide how you're going to set yourself up. So hopefully that helps.
Yes, thank you. We have two more questions that we have in the queue right now. So let's get these answered and then get back to your presentation. This attendee would like to know, if they sell some stock to an investor, who do they need to inform? Which New York State Department, FinCEN, IRS, who is required to know about that?
Yeah, so that's a great question. So typically, if you are if you are taking on investment and issuing stock, there is some regulations with the SEC that your company may need to file some basic information with. So it's not like you're like doing an IPO or issuing stock to the public, but if you issue stock privately, if it's a C corporation, there could be some regulatory filings that your attorney may need to do with the state where you registered, or potentially some information may need to be filed with the SEC. So it just depends on the type of stock that's being issued. In other cases, if it's just like a friends and family type of situation, then there may not be any real reporting mechanism where you need to be telling anyone, but it just needs to be documented with the state that you've issued additional shares, and you can only issue additional shares if there are shares to be issued. So typically what happens is you have to file a restated articles of incorporation to indicate how many additional shares are going to be needed to be issued. You don't necessarily at that point have to tell them, the investors. You're just saying that, hey, we need more shares that we now need to issue, because you can't just sell shares out of thin air. So there is a reporting mechanism. And again, this is more a question for an attorney that you need to discuss depending on your entity type. So yeah, hopefully that helps.
Thank you. And so we'll do one last question before we move on, and then catch some more questions in just a bit. And I'm not sure if you, Akshay, or Greg is the, which one of you is the very best person to answer this one, but we have someone who has recently moved from New Jersey to New York and is interested in knowing about how to get their business registered here. So like I said, I don't know, Akshay or Greg, which one would be the best person to answer here?
Akshay, would you like to?
Yeah, I have a slide here on state income and franchise taxes that I could probably go over, and I think that may help answer a lot of that question a little bit more broadly. So with state income and franchise tax rules, where you incorporate is like the first state where you need to file. So if you are incorporated in the state of Delaware, you need to file a franchise tax return in the state of Delaware, whether you're an LLC or a C Corp. And most tech companies that are set up that way, that's where they initially file. Then the second question is the other states where you need to file. What determines that is what type of activity is happening in the state. Do you have employees in the state? Do you have customers in the state? Do you have an office in the state? Is there inventory located in the state? So there are many factors. And for example, tech companies that are located in Manhattan need to register to do business in the state of Manhattan, in the state of New York, I should say, by filing a certificate of authority to do business in the state of New York. So if you're a New Jersey company now moving to New York, you may need to file this certificate of authority to do business in the state of New York as a foreign New Jersey entity. And depending on what more activity you have happening in New Jersey, you may end up shutting or trying to transfer everything over. And again, that's a conversation you need to have with your attorney if like you've just completely moved and there's no other activity happening in the other state. The other thing is, where are your co-founders located? Like if there's multiple people in your team, let's say you move to New York, but your partner still works in New Jersey, then you may need to file in both places. And the same thing goes for state payroll taxes, right? So outside of the federal payroll taxes like FICA, which is Social Security, Medicare, and federal unemployment taxes, there are other state taxes like disability insurance that you have, state unemployment insurance, and workers' comp. Workers' comp penalties in New York are fairly severe, and a lot of startups have miss this. The penalty for not having workers' compensation insurance if you have employees is $2,000 for every 10 days you don't have it. So we've frequently seen companies receive notices saying, hey, you owe the state workers' compensation board $10,000, pay in 30 days. And then it's very difficult to try and reverse those penalties and settle for less. So another thing is sales tax. So sales tax is determined typically by nexus, which is the physical connection or economic presence that you have in a state. So yeah, hopefully this helps that question and just more broadly, the overall questions that folks had.
Thank you. Please carry on with your presentation.
Great. This was, let me just see if I've skipped anything. Okay, startup expenses. So this is something I want to talk about for the new businesses that have just began business in 2024. So if you just began your business in 2024, chances are that some of those expenses that you paid out were on your personal credit card, or were just more like you were paying your attorney to just get the company set up. There's a special regime under the Internal Revenue Code, Section 195, that dictates how startup costs get deducted. Typically, you could deduct up to the first $5,000 of startup expenses in the first year, and then anything over 50,000 needs to be reduced by anything that goes over 50K and then spread out over a 15-year period or 180 months. So if you have startup expenses, if you're a brand new business, make sure you speak to your accountant about this as well, because this may impact you. What we've sometimes seen is companies take a full tax deduction for everything they spent money on, even though that may not necessarily be allowed. So some examples of startup expenses would be legal costs, costs that are analysis or of potential markets, advertisements for the opening of the business, and even payments to employees and contractors that are just being that are in the training phase, some travel and other costs of securing prospective distributors, suppliers, and customers, and any other professional fees you pay would be sort of captured in this bucket. So I commonly see this being skipped, and it's something that I think tech companies and other small businesses need to just be aware of, especially if this is your first year in business. I touched on the state income tax. Sales tax, the other thing I'll just mention here is nexus. So I mentioned that could be your physical connection or your economic presence to the state. There was a tax court ruling a few years back, Wayfair, which is the popular e-commerce company that sells, household items. That court case meant that even if you weren't located in the state, you potentially now could owe sales taxes in the state. So for those of you in the audience that already have customers in multiple states, please be aware of some of these thresholds. The general threshold is $100,000 of sales or 200 transactions in any particular state may potentially trigger a sales tax filing requirement. And thresholds differ from state to state. So for instance, for New York and California, the thresholds are fairly significantly higher than 100,000. But in most cases, every business needs to be filing a sales tax return. The main reason to file a sales tax return in your home state, at least, like let's say New York is your home state, is that it starts the statute of limitations clock. Essentially, once you file that sales tax return, the state has 3 years to come back to you to either challenge what you reported, even if it's zero. But after that 3-year period, they really can't come back and like open up all of your books and records. So I usually recommend businesses, especially tech companies, file sales tax returns, even if you're not reporting anything at the bare minimum in the states that you operate in. So we spoke a little bit about payroll. I think the main thing for startups here is like confusing the employment laws between who's an employee, who's a contractor. And this is like a big thing that startups need to be aware of. And if you fall afoul of this, you may be on the hook for significant penalties and interest as it relates to employment taxes. I'm going to quickly touch on R&D tax credits for any of you who are investing in research and development in the United States. That would be like hiring software engineers or other folks that are involved in research and development. You could benefit from the R&D tax credit. It helps offset your payroll taxes, but it can also offset federal income taxes. Typically, we see these credits being used by brand new startups that have raised capital. So if you've raised VC funding, you would be probably a more prime candidate rather than a company that is bootstrapping. But if you're bootstrapping and you've hired employees that are working in these areas, it could work. The one thing is with the R&D credit, there is like a 4-part test that you have to cross, so which is pretty rigorous. So typically we recommend, if you're going to be pursuing this, to work with a provider, either a firm like ours or another firm that has experience with the R&D tax credit. But the benefits could be fairly significant. So I'll just give a back of the envelope calculation. If, let's just say, there was a tech company that hired software engineers, and for an entire year they were in the process of experimentation and sort of discovering how to create a new technology. If they spent $1 million in that process, approximately 10% of that, or $100,000, could come back to them in the form of a tax credit. So this is something that you need to look into if you are in the fortunate position to be able to take advantage of it. So something that some businesses can do. So there are some rules. You have to have less than $5 million of gross receipts in the year that you make a payroll election, and $0 in gross receipts in any tax year preceding a 5-year tax period. So this is to qualify for a payroll tax credit. And the main reason here is some tech companies are generally losing money, so the income tax credit isn't that useful, but the payroll tax credit is more useful. So that's why the payroll credit is more valuable, especially for startups that are in that R&D phase. And I guess the other two things I'm going to quickly touch on is R&D capitalization. This is a new rule for 2022 and tax years after it. Any R&D expenditures that you have in the United States, for tax purposes, they have to be spread out over a 5-year period. So if you hire a developer, let's say, and for foreign expenses, that would be over 15 years. So I'll just give a quick example. Let's just say you hire a software engineer, and that software engineer is based in Europe, and that individual's helping you with building your back end or your front end of your tool. Their costs, you wouldn't be able to take that 15,000, let's say you pay them 15K, you wouldn't be able to take that as 100% tax deduction in the year that you spent the money. You would have to spread it out over 15 years for tax purposes for foreign expenses, and anyone you pay domestically over a 5-year period. So this is something that I would definitely recommend touching base with your accountants on. And I think final thing I want to touch on is this January 1st deadline, which is the Corporate Transparency Act. This is a new rule that covers most small businesses, organized as LLCs, corporations, and S-corps. And I believe there's a link in the chat that gives more information on this. So if you're already incorporated, which it looks like 2/3 of you are, most of you are going to have to deal with this filing. It's a fairly simple filing, but it can be complex depending on a few factors. So, I would definitely reach out to the right professionals to help you with this, whether it's accountants like ourselves or other attorneys, and/or attend the workshops that the New York SBDC are recommending to attend. And with that, we've got a founder guide here. So if anyone wants to scan this QR code, you can download this free GAAP accounting guide to give some tips on your bookkeeping and financial reporting. And the other thing I will just leave you with is my contact details here and our website. So if anyone has questions, you can feel free to reach out to us. And with that, I'll turn it back to Jenny for any final questions.
Yes, thank you. We're at 3 o'clock, but do you have a moment to answer the remaining questions, or do you need to go?
Sure, I have some time.
Okay, wonderful. We actually had 2 questions about this topic. And so one wanted to know, if you're not paying founders yet, do we need to abide by the rules you've been presenting today? And another one wanted clarification on when you say first year of business, does it make a difference if you are pre-revenue or inactive for a few years? So a few questions about this, not paying people yet.
Yeah. Okay. Yeah. So let me start there. So if you don't have payroll and you haven't paid any employees, including yourselves, then typically you may not need to have all of the payroll taxes set up. But if you are hiring contractors in the state of New York, you may still need workers' compensation insurance, especially if those individuals are working in your office or out of, let's say you're out of a co-working space or a university incubator. You want to make sure that you're covered. So there may be some coverage that you need just to cover that. But if you're not paying anyone and you don't have any contractors, then you may not need that insurance or the pay any payroll taxes until you get to that step.
Thank you.
And
Could you,
the second
yes.
question was, yeah, can you clarify that?
So they were saying, when you're in the first year of business, does it make a difference if you are revenue or inactive for a few years?
Yeah, so my recommendation here is any business should be filing as soon as you register with the state as a LLC or a corporation. At that point, you are obligated to be filing tax returns, even if you are inactive. There is a way to let the state know, for instance, with the state of Delaware, that you're an inactive company, but that doesn't necessarily mean that you don't pay taxes or you don't file a tax return. So you could still file a tax return just showing essentially that there was no activity during the year. So that's what we recommend most small businesses or even tech companies to do, is just file a tax return annually, even if there's nothing to report.
Okay. Could you go back to that founder's guide page? We have somebody who missed the QR code and would like to snag that. Thank you. This person for this next question is interested in software for state sales tax. Is there software for state sales tax?
Yeah, so there are various states that the sales tax for software or SaaS where it's taxable, and there are some states where SaaS is non-taxable. So for instance, California doesn't charge sales tax on SaaS, but New York does charge sales tax on SaaS. So each state has slightly different rules. So it depends on where your customers are located and where you as a business are located. So that is it's not there isn't a silver bullet to that question. Like it's kind of very state specific. Depending on the states you're operating in, there may be slightly different rules regarding sales tax. There are a couple of companies that we work with that specialize in sales tax. One is called Avalara, Avalara, and another company which is a fairly newer company called Anrock, Anrok. I would recommend maybe take a look at their websites. They have quite a few user guides and information on that, but please consult with your tax advisors and your legal representation as well as a first step.
Got it. And what about software solutions for monitoring sales tax?
Yeah, so tools like Avalara that I mentioned or Anrock, Stripe has their own platform called TaxJar. QuickBooks also has a sales tax platform. So multiple tools have these either integrated, or you can use a third-party integration. If you're using Shopify, for instance, there's a third-party tools you can integrate into Shopify to help you stay on top of your sales tax or monitoring whether you're crossing certain thresholds. So those be probably some of the common ones.
Okay. Then to wrap up today, we have two questions about single member LLCs. So first of all, do single member LLCs need to file the BOI as well?
So on the link, let me just go back to the BOI. Yeah, so the BOI there are certain exemptions for the BOI. I don't have them listed here, but if you go to the FinCEN website, if you meet one of those exemptions, you may not need to file. But in general, most small businesses are covered by this mandate. So it's some single member LLCs. If you have more than 50 employees, I think is the rule, you may not need to file a BOI report. But if you're under that, you would. So definitely look at the link. And I think that could be shared in the chat. Let me. I'm not sure. Greg, did you share the BOI FAQ in the chat, or
I
yeah,
shared a more general link. Yeah, which is in the chat. The link you're referring to, they can access it there.
Yeah, I will just put in the chat right now this link to the FAQ, because in that FAQ they have a few nuanced questions. But for most single member LLCs, they will need to file.
Thank you. And your colleague Nina also had a link to share there.
Okay, great.
Thank you. So our last question for today then, if an attendee is here today and they're wanting to establish a single member LLC, is it better to establish it in New York or another state like Delaware? You mentioned this earlier, that you work with a lot of businesses who have incorporated in Delaware. So what are your recommendations around that?
Yeah, great question. I think it really kind of boils, and I mentioned this a little bit earlier, it really depends on your goals for the company. If you are going to be bootstrapping the company and likely not going to be taking in any outside investment, you could set it up as a New York LLC. If you think that at some point in the future you may be raising outside investment, it may make more sense to set yourself up as a Delaware LLC. But with that being said, if you set yourself up as a Delaware LLC, you'll still need to register in the state of New York to do business, and then still file a return in the state of New York. So you'll have 2 filings a year. So if you are sort of just bootstrapping and you don't want to have to deal with all these additional fees and multiple tax returns and multiple deadlines, keep it simple and just keep it in New York. It really depends on your personal residency as well. If you're living in New York, if you're living in New Jersey and you're setting up in New York, that's another thing. So it just depends on your individual circumstances. And again, just speak to your accountant and your legal advisor, and they can probably help you based upon your specific facts and circumstances.
Well, thank you so much, Akshay. You've been so generous with answering questions over time today. We really appreciate that. And thank you to all of our attendees who have joined us and contributed to this presentation today. When we shut down the webinar in just a moment, you will see a survey. We love to hear back from our attendees and know how you thought things went today, and also what other topics would be helpful for you as a small business owner in New York. With that, I will turn the time over to Greg for any final closing remarks from the PACE SBDC.
Thanks, Jenny. And first, I want to thank you, Akshay. Tremendous presentation. I'll echo the comments that we've got from some of the attendees. Yeah, you are outstanding. So we thank you for your time and sharing your knowledge. Jenny, thank you for making things run smoothly, as always. And to the attendees, thank you very much. We appreciate you tuning in. Hope you enjoyed it. Hope you found it helpful. And again, we would encourage any of you who are interested in receiving services from our organization, the PACE SBDC, to visit us at our website, pacesbdc.org. Again, all of our services are totally free of charge. It's what we love to do, so we'd love to try and help you.
Thank you so much, Greg.
Thank you, Jenny. Thank you, Greg, for your help facilitating this. Appreciate it.
It's my pleasure. And please, if you do have further questions, feel free to reach out to the PACE SBDC, sbdc@pace.edu. And they are fantastic with answering all sorts of business owner questions. And so don't hesitate to go ahead and get in touch with them. And like Greg said, all of our services are free since we are a government-funded program. With that, I'm going to say goodbye to everyone. Have a lovely rest of your day and look for that follow-up email with the link to the recording and slides coming up soon. Bye-bye, everyone.
Bye-bye. Thank you.